Hi, I'm Bart Basie. I'm a CPA and an attorney, and I've got a doctorate in accounting and business economics from Indiana University. You can put that together, and with about $3 or $4, you can get yourself a good cup of coffee. But having said that, I'm glad you're with me. The subject we're going to talk about now for the next hour is asset valuation. Extremely important subject for all tax return preparers in the United States. And you might say, Bart, why should I study asset valuation? I'm filing tax returns. Well, two reasons. There's tax forms that require that whatever the assets are that are changing hands via a gift or a sale have got to be filed and got to be reported. If you look at slide number 2, you're going to see that one form is a 706 form, and another one is a 709 form. And this provides a service to your client. It's very difficult if you find that a client comes in and says, well, I'm giving some of my stock in my company away, or I'm giving this art collection away, or I'm giving my antique guns to my grandson, and he wants to take a charitable deduction for it, or in some cases, he wants to take a charitable deduction for it. So you'll notice, for example, in the different bullet points I've got on the slide number 2, you can do it for business succession reasons, gift valuations, estate planning purposes. In a lot of cases, when a person passes away, it's very, very important to value the properties involved prior to filing an estate tax return, because you get what is called a stepped-up basis in a lot of these things. And that is critical. I'll stop just for a second to talk to you a little bit about what I mean by stepped-up basis in case you're not familiar with it with an estate tax return. When an estate tax return is filed and property is transferred, let's talk about land. The land might have cost the deceased person $100,000, just to pick a figure. You can take off zeros, you can add zeros. I want to give you the concept. However, when that property is transferred to an heir, the property is not necessarily transferred at the cost to the deceased. You need to value that asset, that property, and find out what the fair market value is at the time the deceased passed away. Let's say that that property is worth $170,000. It's gone up 70% from the time the deceased purchased it, acquired it, and the time the deceased passed away. And let's assume that the heir who's going to receive that property doesn't want it. They want to sell it. If you value that property at $170,000, which is the fair market value at the time the deceased died, and I'll talk about the valuation methods in a while. The key is if you value it at $170,000, then the heir receives it at $170,000. That becomes the heir's basis. So when the heir sells it for $170,000, there's no income taxes, because he acquired it at a value of $170,000. He disposed of it at $170,000. Therefore, there's no income tax. There's no profit on the transaction. If you fail to properly value that asset, then what happens is you report it on the estate tax return at $100,000. The heir receives it then at $100,000 and has to pay taxes on a $70,000 profit. So this stepped-up basis means that all property, all assets transferred, for example, in an estate, can be valued at their fair market value at the day of death of the deceased, so the heir gets a stepped-up basis and pays no income taxes on that increase in basis. Now, you might ask me, you might say, well, wait a minute, Bart, isn't there an estate tax? Not necessarily. We're going to do a program, and hopefully you'll watch it, on estate taxes. And you're going to find that there's a gift and estate exemption, which is in excess of $5 million. Very few of your clients or mine might hit that level. And therefore, even though they will get a stepped-up basis and you'll file an estate tax return, there may be no estate taxes due. So you're saving not just estate taxes, but you're saving income taxes. So you might say, that's a key reason to understand any asset valuation that you have to place on these tax returns. Like I said, Form 706 or Form 709, depending upon the situation. Okay? That's that possibility of stepped-up basis. Very, very critical.